Hey there, what is a hedge fund? Imagine a group of investors who want to beat the market, not just follow it. This brings us into the world of hedge funds. But what exactly are they? A hedge fund is a pool of money contributed by investors and managed by professionals who employ various strategies to achieve high returns. Unlike mutual funds, hedge funds often use leverage, go long or short on stocks, and invest in a wide array of assets. The core idea of a hedge fund is to hedge or protect investments against losses, while also seeking to maximize returns. They do this by balancing risk through various sophisticated strategies. The concept of hedge funds isn't new. It all began in 1949 with Alfred Winslow Jones, a sociologist turned financier. He created the first hedge fund by going long on stocks he thought would rise and short on those he expected to fall, aiming to make money in any market condition. From then, hedge funds evolved, growing in number and complexity. They became known for their aggressive strategies, high fees, and their ability to deliver outsized returns, albeit with higher risk. Today, hedge funds play a significant role in global finance. They manage billions in assets, influencing markets, and are often seen as the playground for the wealthy and institutional investors looking for returns beyond traditional investments. So, while hedge funds might seem like a complex financial tool, at their heart, they're about trying to do better than just riding the market wave. In the next video, we'll dive into how hedge funds differ from other investment vehicles. Stay tuned.